The consistency concept in accounting. The consistency concept in accounting means that similar items should be treated the same way within a set of financial statements. It also emphasizes that once a business chooses a particular method of accounting, it should stick with that method from one period to the next unless there is a compelling reason to change. This concept ensures uniformity and it makes it easier for users to compare a business's performance over time by preventing constant changes in accounting methods. Understanding the consistency concept. The consistency concept is quite straightforward. It encompasses two key principles. Number one, similar treatment. This principle advises that similar items or transactions should be treated in the same way within one set of financial statements. It's like saying, if it looks the same, treat it the same. This consistency ensures clarity and logic in financial reporting. Number two, staying the course. The second principle emphasizes that once a business decides on a particular method of accounting, it should stick with that method from one period to the next, unless there is a very good reason to make a change. It's all about maintaining a consistent path in accounting practices. Let's explore the relevance of the consistency approach. The consistency approach or the consistency concept holds immense relevance in the world of accounting for several compelling reasons. These are the reasons: clarity and comparability. By treating similar items the same way, the consistency concept promotes clarity and comparability. Imagine reading a book where the author keeps changing the meaning of words. It would be bewildering. Similarly, when financial data is consistent, users can easily comprehend and compare performance of a business. Reliability and trustworthiness. Consistency enhances the reliability and trustworthiness of financial statements. It's like having a reliable friend who always acts predictably. When a business sticks to its chosen accounting method, it fosters trust among stakeholders by showcasing a commitment to financial transparency. Let's look at the practical application. The practical application of the consistency concept in accounting is not just a theoretical guideline. It is a fundamental practice that impacts various aspects of financial reporting. Let's explore some real-world scenarios to understand how this concept is put into action. Inventory valuation. When a business chooses a method to value its inventory, such as FIFO, which means first in, first out, or LIFO, which means last in, first out, it should consistently apply that method every financial year. For instance, if a grocery store decides to use FIFO method, it means they will sell the oldest stock first. By maintaining this method, the store provides a consistent and reliable picture of its inventory costs, allowing stakeholders to assess its financial performance accurately. Depreciation. The consistency concept is also vital in the depreciation of assets. When a company selects a depreciation method, like straight line or reducing balance, it should stick to that method for the entire useful life of the asset. This practice ensures that the value of assets is consistently reduced over time, reflecting their true wear and tear and making it easier to compare financial statements from one year to the next. Revenue recognition. In businesses that offer long-term contracts or subscription services, the consistency concept plays a significant role in revenue recognition. For instance, Consider a construction company that uses the percentage of completion method to recognize revenue on a large building project. Once they select this method, they must apply it consistently throughout the project to provide stakeholders with a clear and steady view of their financial performance. Taxation. Tax regulations often require businesses to maintain consistency in their accounting methods for tax reporting purposes. For example, if a company uses the cash accounting method to report income for tax purposes, they should continue using this method unless there is an approved reason for change. Consistency in tax reporting ensures compliance with tax laws and minimizes the risk of audits or disputes with tax authorities. Financial statement presentation. The consistency concept also impacts how financial statements are presented. If a business changes its accounting policies, it must disclose the nature and reason for the change, along with the impact on financial statements. This transparency allows users to understand the change and adjust their analysis accordingly. In all these real-world scenarios, the consistency concept functions as a steadying influence within the realm of accounting. It plays a vital role in enabling businesses to furnish their stakeholders, be they investors, creditors, or regulatory authorities, with financial information that is dependable, comparable, and trustworthy. By steadfastly adhering to this concept, businesses underscore their dedication to financial transparency and responsible accounting practices. This dedication, in turn, guarantees that the financial statements consistently present an accurate representation of the business's financial well-being. Ultimately, this aids in facilitating informed decision-making in the realm of finance. If you're new to the world of accounting and have been following this video series from the first video in their order, some of these practical applications might appear a bit complex at this stage. However, there is no need to be overly concerned about grasping them entirely at this point. As you continue your journey and explore new topics, you will naturally encounter these practical applications along the way. For now, the most crucial aspect is to understand the significance of the consistency concept. So as we conclude, in the consistency concept as a guiding light, in the ever-evolving landscape of finance, the consistency concept stands as a guiding light for business and accountants alike. It ensures that financial data remains clear, uniform, and dependable. By treating similar items consistently and sticking to chosen accounting methods, this concept facilitates trust, simplifies financial analysis, and upholds the integrity of financial reporting. Just as a reliable friend stays true to their nature, the consistency concept ensures that financial statements remain constant, making it a vital pillar in the world of accounting. It's the compass that keeps businesses on a steady course, guiding them through the intricate web of financial intricacies. My name is Arnold Kisembo Purangakuramya. Thank you for watching.